Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Washington State and talk to the original silver guru himself, David Morgan of silverinvestor.com. That's silver-investor.com. David Morgan, welcome back to the Keiser Report.
Max, great to be back.
All right, David Morgan, you are, of course, the silver guru. But before we get to silver, I want to talk bonds. You've recently made a bold call. Is it time to short bonds? David Morgan, are you the guy to make the right call? Many have come before you and been wrong. Are you the man?
Well, Max, to be totally honest, and I am, I've made a couple calls. I said recently and actually over the years that there'll probably be more money made shorting the bonds in the U.S. bond market than anything else you could possibly do. There's so much leverage available through the ETFs, the double ETFs, options, and, of course, the futures market. And I've actually taken a stab at it a couple times, not very confidently. In the two cases that I recall, I used options myself, and actually these bonds just kept treading along. So is it the right time or not? I don't really know. Certainly near the top. How long this can be prolonged with this almost zero interest rate policy. Obviously, the bonds have had a great run for 30 years. And if I might digress, Max, we might talk about what's happened over the last 3 decades in the bond market, if you'd like to visit that.
Well, let me ask you this. The bonds are up. The yields are low. We know that the biggest buyer of U.S. government bonds and treasury bonds around the world are the respective governments that issue these bonds in various guises like quantitative easing. They don't call that manipulation. We also know that in London you got the LIBOR scandal where the government was caught with Barclays buying back bonds while simultaneously manipulating interest rates down around the world to make it profitable for them to commit manipulation. So why do we even care whether bonds are going to collapse or not collapse in the short term? Because they're being manipulated. So you're not making an economics call. You're making a call by inferring, if you are, that the fraud, the Ponzi scheme, the criminality of the Bank of England and the Fed is about to end. Is that what you're saying, David? Because it's not economics anymore.
Yeah, I agree, Max. Look, it's impossible to pay this back. And this is probably the most sure bet you could possibly make that it cannot continue. I mean, it is impossible to pay off any of the interest on these bonds, even at these low interest rates. It's impossible. So anyone that would buy these bonds doesn't, have the conception of basic arithmetic. So that's a fact. So the only way you could default is you actually admit, these bonds won't be paid back, or anyone that's a foreign holder of these bonds won't be paid and only U.S. citizens will, or who knows what they could come up with. But that's so unlikely. I just barely touch on that idea. The more likely default is they default on the currency and they just keep printing it into oblivion. And when that happens, obviously anything associated with the U.S. dollar, be it the dollar bills or $20 bills in their pockets, or the equivalent debt associated with that, and of course a dollar bill is also a debt instrument, will collapse. So you could have $1 million in bonds, or 10 or 20 or billions or trillions. Doesn't matter when it goes to zero or near zero. And this is what happened in the Weimar Republic. Now, I'm not predicting it to go quite that way, although it could. But they're living on the razor's edge right now. It's going to take just a small gust of wind to push them off the cliff, as far as I'm concerned. I think we're very near the edge. Am I right or wrong? I know I'm right in the long run. Is it going to happen by the end of the year? Is it going to happen in 2013 or 14? I don't know. But I know I wouldn't touch a bond. You couldn't pay me to take a bond.
I'm just looking at this list of names of people that have made a call like this and been wrong. Bill Gross, Jim Poplava, Jim Rogers, Mark Faber, Peter Schiff. They've all made this call over the past 3 or 4 years, and they've all been wrong. The only guy who's gotten it right, as far as I can tell, is Mike Shedlock, who has been long bonds. But you are stepping out there, David Morgan, and you're planting your flag on this call that now is the time to short bonds. Now, let's talk about silver. The big news in silver on the front page of the FT announcement was that the CFTC had closed their investigation into silver manipulation. Bart Chilton, the wavy-head pinup girl for the CFTC, was out front on this one. The LIBOR scandal has proven without a shadow of a doubt that Bank of England and Barclays and the money center banks are manipulating interest rates. So why should we be surprised that they're manipulating silver and gold? I mean, silver is the inverse of interest rates. So it's, even if you admit it or not, by manipulating LIBOR, you are manipulating silver. The two things are part and parcel. Silver is a currency. Gold is a currency. If you manipulate LIBOR, you're manipulating precious metals. That's an axiomatic truth that doesn't have even any questions to it. David Morgan, your thoughts?
Max, is true. I mean, Jeff Christian, who's been pretty forthright on how the bullion banking system works, has always said that it's a leverage factor of roughly 100 to 1. And the only commodities that have the exact same derivative exposure are gold and silver, treated exactly as if they are a monetary instrument, which they are. So I'm just backing you up on that, and Jeff himself has said it many times. So they are treated as money. They are money. They've always been money. They always will be money. And yet there's only less than 1% of the world's population that even has woken up to that fact. But all we need is like a doubling of people to raise their consciousness to the fact that gold and silver is really the only way out. And you could see paper price on these markets that would be ridiculous to state on your show.
Right. It's a good point there about paper price, because we're finding out more and more that these exchange-traded funds are really more aligned with the paper price that you find on these futures markets, whether it's MF Global or Peregrine or these other houses that are being stolen from by the money center banks like JP Morgan, or it's an ETF that has no seniority at all for the claims owned by the shareholders of these exchange-traded funds in these metal trusts. That's all paper. And that's a huge mistake, isn't it, David Morgan, for people to own a silver ETF at this point? You might as well just throw your money in the garbage, right?
Well, some are. There's a big group that are lumped as ETFs, and not all ETFs are the same. I mean, SLV is one I wouldn't touch unless I'm just doing it as a hedge. But the PSLV, like the Sprott Physical Silver Trust, I would think that one's fine. It's lumped as an ETF. Really, it's a holding company in my view, and you can take the silver out of there. So if you have an ETF or a holding company where you can get the silver or gold out into your own hands, then I think that's a safe investment. So there are ones that are much better than the paper ploy derivative up the kazoo rehypothecation to the moon and back. Those are ones I would stay away from. Right.
Sprott up in Canada, he's got a holding trust which has got a good reputation. We'll have to have him back on soon. Now, the front page of the FT piece mentioned the crash JP Morgan Buy Silver campaign from last year that took silver from 25 to 50. But they didn't mention the Silver Liberation Army by name. But tell us about the silver buyers these days. Eric Sprott, we just talked about. He recently bought $200 million worth of silver. He's got to be silver vigilante number one. Tell us more about who's in this space to knock and crack some skulls of the paper bugs.
All these bigger funds or trusts or ETFs that understand what's going on, like take Central Fund of Canada that's been around for a very long time. Look at their holdings. Look at what they've done over the last decade. They continue to buy more. Are they going to cash out because silver makes it to $33? Are you kidding me? No, they're going to buy more. So once the momentum starts to move in the silver market, I'm forecasting somewhere around a $33 to $35 level. You're going to see a lot of these guys come back in size. They're coming back in size in a very tight market. There isn't a lot of physical left. And so when those two equations meet, you're going to see, I think, a real strong move probably to 40 rather rapidly. And then we're not going to take too much time, in my view, to build a base in that level. And then once we start above that, then who knows? Once we get above the $50 psychological barrier that's taken so long to get to, and we only touched it April 2011, once we get above that and we stay for a couple of weeks, I could see silver going from 50 to 75 in a matter of a couple months or maybe even less. That's the way this market can move, and that's the way this market will move.
Right. Sprott comes in with millions of ounces to buy, and the price moves up, half a buck or something. But people have to understand that for every $1 million in silver that Sprott puts in the market to buy, 50 million ounces of paper silver arrive on the sell side. Conversely, if somebody shows up with $1 million worth of silver to sell, then suddenly there's no buyers at all, and you see the price drop precipitously. That's what manipulating a market's all about. All the buys are met with a wall of paper sell orders, mostly from JP Morgan, using naked short sales, leveraging their own balance sheet, leveraging their own stock, like Enron did before them. to defend the paper world, the dollar, the U.S. debt market, the hologram that is the U.S. economy. They're willing to sacrifice their company, their stock, the dollar, the Fed, the Treasury, the White House. Jamie Dimon is an out-of-control rogue. Yes or no, David Morgan?
Out-of-control rogue. Well, I'll just leave it at rogue.
Finally, silver is in backwardation. So tell us what this means and what we can expect to see going forward into the end of the year, David Morgan.
Backwardation means that you have to pay more for the physical market than you do for anything in the future. It's a term that's used in the futures market. It can apply to corn or any futures contract. So you actually have to pay more now to get the product you need. Again, it could be corn, it could be silver, it could be anything, than you do to buy it in the future. And usually those aberrations only last a short period of time, like a matter of days, and then the market goes back into contango, and contango is just a fancy word that means that everything costs more in the future, and that's based on the interest rates of whatever government's holding the commodities, which is the U.S. the U.S. bond market right now. So the contango is very low in all the commodities because interest rates are so low. But that's what backwardation means. It's a sign that it's a very tight supply. It's a sign that somebody needs it badly. They're willing to pay up more than the futures price to get it. And again, it usually doesn't last very long.
Well, yeah, it doesn't last very long because it's an arbitrage that usually disappears within the market quite quickly. Right. And as you point out, it goes back into the normal contango. So the fact that it's been in backwardation for week after week, month after month, again, clear evidence of manipulation. So Bart Chilton, when he's done blow drying his hair, he needs to look at backwardation in perpetuity, the sell-buy imbalance that's been going on for years now, 50-to-1 imbalance at the point of the specialist market making right there on the various exchanges around the world. Plus the admitted J.P. Morgan balance sheet by the Bank of International Settlements exposure, as it's right there as a line item, to 3 million ounces of silver naked on their books that they're exposed to, 3 times bigger than the entire market capitalization. All right, David Morgan, we've got to leave it there. We're out of time. Thanks for much for being on the Keiser Report.
Actually made my day, probably my week. Thank you.
Well, we'll have to come out there to Washington State and visit you soon. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. And I want to thank my guest, David Morgan. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.